Before we begin, be sure to click like and subscribe. It's free to keep the algorithm happy. In today's episode, we're going to continue our discussion of the accrual method of accounting. Specifically, we're going to discuss when you have to include an amount in your taxable income if you're using an accrual method. If you haven't watched the introduction to the accrual method in episode 3, you might want to do that first. Recall, in episode 3, we said that if you're using an accrual method, you take an item into income in the year in which two things have occurred. All of the facts have occurred that fix your right to that income, and the amount of the income to which you're entitled can be determined with reasonable accuracy. And that's still the basic rule of the all events test. But as with everything in the tax world, there are some wrinkles you need to be aware of. The wrinkle we're going to discuss today is the book conformity requirement added to the tax code in 2017. Before 2017, the traditional two prong all events test operated just as we discussed. In addition, the Supreme Court had held in Thor Power that the method of accounting you use for tax purposes has an altogether different purpose than the accounting methods that you use for financial accounting purposes. To grossly oversimplify things, tax tends to favor accelerating income and deferring deductions. The government is anxious to collect taxes, while books tends to follow a principle of conservatism to delay recognizing income longer than might be the case for tax purposes, so that potential investors don't get an artificially rosy picture of the company's finances. So before 2017, when it came to accruing income, books and tax pulled in opposite directions. That was the basic rule for a very long time. But in 2017, Congress amended the tax code to add a third element, a book conformity rule. Now, under Section 451B, you have to treat an amount as income for tax purposes upon the earlier of 1. Satisfying the original two pronged all events test, or 2. Including the item in revenue for book purposes. As a result, it isn't enough to just pay attention to when you meet the original tax rules we discussed in episode 3. Now, a company's tax department has to coordinate with the financial accounting department so that the tax group knows when an item is being included in revenue for book purposes. It didn't matter before, but now, under the book conformity rule, you have to include that same item in taxable income in the same year as books, even if the original all events test has not been satisfied yet. So it's important that tax and books coordinate with each other. In applying this new requirement, the key questions you have to ask yourself are: first, is this type of income subject to a special method of accounting? Things like the installment method or the long term contract method, or special methods of accounting for various financial instruments or for farmers. If so, you apply that special method of accounting for tax purposes, and you don't need to worry about the book conformity rule for that particular item. Second, if it's not subject to a special method of accounting, has this particular item already satisfied the traditional all events test this year? If so, then you include it in income in whichever year it meets the all events test. And again, you don't have to worry about the book conformity requirement. Third, if the income is not subject to a special method of accounting and it does not satisfy the traditional all events test yet, now you have to start thinking about the book conformity test. The first question is whether your company has an applicable financial statement, an AFS, for this entire tax year. An applicable financial statement is something like audited financial statements or financial reports that you have to file with the SEC. If not, the book conformity rule doesn't apply to you at all. And since the income hasn't satisfied the all events test yet, You don't have to include it in income until it does. If you do have an AFS for the entire tax year, the next step is identifying any items that have been included in book revenue for the year, but that have not yet satisfied the traditional all events test. This is where coordination between the book and tax departments of the company is now critical. If you have an AFS for the entire year, you have to identify all of the book inclusions that might be triggering this new taxable income requirement. If you do have a book inclusion for the year that has not met the traditional all events test, you next ask if you have elected to use the alternative AFS revenue method under the regulations under Section 451. This option is simpler than the general rule and lets you skip some computational steps that might save you some taxes, but that might not be worth the extra effort. Simplicity comes at a price. If you've not elected to use that simpler approach, you have to apply the general book conformity rule, the AFS income inclusion rule. Under the AFS income inclusion rule, you start with the amount that you are including in your book revenue for the year, and you add to it amounts that have already been subtracted from that amount for book purposes and that are also going to be deducted separately for tax purposes. Things like cost of goods sold or other costs that will be deducted as business expenses for tax purposes. Adding these amounts back to the book income before you include that amount in taxable income is just a way of making sure that you don't deduct the same amount twice for tax purposes. Finally, you subtract certain amounts from the book income item. Most importantly, you get to subtract any amount that you would not be able to collect if your customer cancels the contract during that year. This is referred to as amounts to which you do not have an enforceable right. If you do not have an enforceable right to some portion of the income item, you don't have to include it in taxable income, regardless of how books treats it. Let's focus on this last point because it's really important. Basically, if you have already earned a portion of whatever your customer is going to owe you under the contract, you have an enforceable right to that amount. That amount is treated as already being your income under the book conformity requirement, even if you don't have the right to demand actual payment yet. For example, let's say you're building a custom made vehicle for a customer for $1,000, payable when the delivery is made to the customer. It's the sort of vehicle that no one else would want. So if your customer cancels the contract, you won't be able to sell this thing to anyone else, and you would lose whatever you've spent to build it so far. So the contract says that if the customer cancels the contract before you deliver the vehicle, you're entitled to whatever you have spent so far, your costs, plus 5% of that amount. But unless the customer cancels the contract, you're not entitled to actual payment of any portion of the contract price until delivery, which you expect to occur sometime the following tax year. As of the end of year one, the customer has not canceled the contract, so does not actually have to pay you anything yet. Your total cost so far, plus 5%, equals $400. Let's also say that for financial accounting purposes, you're required to include that $400 in your book revenue for year one because you expect to receive at least that amount even if the customer eventually cancels. Under the book conformity requirement of Section 451, you have to include that $400 in your taxable income in year one as well, even though it doesn't satisfy the all events test yet because contractually you have an enforceable right to the $400 that is being recognized for book purposes. Now, what if the contract also says that you're entitled to an additional $100 bonus if you deliver the vehicle on time and it's acceptable? You fully expect to receive the bonus, but you don't have an enforceable right to any portion of the bonus until the contract is completed on time next year. In that case, books might include the $100 bonus in revenue in year one under financial accounting standards because you expect to be entitled to the bonus. But because under the terms of the contract, you do not have an enforceable right to any portion of the bonus until the vehicle is delivered in year two, you do not have to include any portion of the $100 bonus in taxable income in year one. The book conformity rule does not apply to the bonus because there is no enforceable right to the additional payment as of the end of the tax year, regardless of whether you expect to be entitled to it eventually. Instead, you wait until that amount satisfies the traditional two pronged all events test we talked about in episode 3. So let's summarize the new book conformity requirement of Section 451B. First, it only applies to companies that have an applicable financial statement in AFS for the entire tax year. Second, it only applies to accelerate income to match book revenue. It has no effect at all on the tax treatment of cost recovery, including ordinary deductions and costs of goods sold. Third, it only works in one direction to accelerate income if books includes it in revenue before the traditional all events test is satisfied. You cannot use it to delay recognizing income after the traditional all events test has been met. Fourth, it only applies to an amount for which you have an enforceable right at the end of the year. And finally, there are a number of special rules, many of them quite complex, for things like income from the sale of inventory and the receipt of advance payments for things like the sale of goods or future services to be provided to customers, the sale of things like gift cards. We didn't discuss these special rules because they're sufficiently complex that they deserve separate episodes of their own. But at least be aware that the Section 451 regulations for the book conformity requirement are not as straightforward as you might think. Well, that's it for this episode. Be sure to click like and subscribe. It's free, and keep checking back for more. So long, everyone.